last video, we prepared a flexible budget and a variance analysis report. And in that report, we compared our actual performance with our original budget. We broke it down into a sales activity variances and spending variances. In this video, we're going to investigate specifically these spending variances that relate to direct materials, direct labor, and our manufacturing overhead. In particular, we calculated or prepared a flexible budget, expected to spend $176,000 for direct materials. We actually spent $196,800 for direct materials, giving rise to a $20,800 unfavorable direct material spending variance. We're going to break that variance down in this video into a price variance and a quantity variance. We're going to do the same with our direct labor, our variable manufacturing overhead, and our fixed manufacturing overhead. We'll explore the difference between the $79,200 actual direct labor cost and our flexible budget amount of $80,000, and so on. In evaluating these variances, we'll make use of our standard quantities allowed. This should be $4 or 4 pounds instead of $4 at 55 cents per pound. Our direct labor standard of 0.05 hours at $20 per hour. Our variable manufacturing overhead at $12 per hour. And then we'll make use of our actual quantities, our actual prices, and the totals. So we're going to make use of this standard and actual cost in calculating those variances. Let's begin with our direct material variance. Again, we're analyzing the difference between our $196,000 actual cost and our $176,000 flexible budget amount, which is the amount that we should have spent for direct materials, given that we produced 80,000 units. Let's begin with picking up our actual quantities, which we were told were 328,000 from above. We were given an actual price of 60 cents per pound. We could have backed into that by taking the actual cost of direct materials divided by our actual quantity. We had a standard quantity allowed, 80,000 units at 4 pounds per unit of 320,000 pounds at a standard or budgeted price of 55 cents per unit. Let's fill in our center column. We're going to take our actual quantity purchased, 328,000 at a standard price. We would have expected to have spent $180,400 to purchase that much material. We can see right away that we have an unfavorable price variance because we paid 60 cents a pound and we should have paid or budgeted 55 cents per pound. We have an unfavorable quantity variance because we should have used 320,000 pounds to make our 80,000 units, and we actually used 328,000 pounds. We can now go ahead and calculate our price variance, and again, that's the difference between the 196 and the 180,000, or more precisely, it's the difference in cost per pound of 5 cents per pound times the 328,000 pounds we purchased. Our quantity variance can be calculated as the difference between the 180,000 and the 176,000, or more precisely, the 8,000 extra pounds that we used at our standard price of 55 cents per pound. In this case, we had unfavorable variances for our price variance and quantity variance. Those two combined gave us our $20,800 unfavorable direct material spending variance. But more precisely, it's the difference between what we actually spent and what we should have spent producing our 80,000 units. Let's go ahead now and take a look at our direct labor variances. Again, we're explaining the difference between our 80,000 flexible budget amount, which is what we should have spent to produce 80,000 units, and the $79,200, which we actually spent. So let's begin by picking up our actual hours. We were told we worked 4,400 actual hours. We paid our workers $18 an hour. Our standard hours allowed would have been 4,000 hours. That's the 80,000 units times 0.2 hours per unit. And our standard labor rate was $20. If we pick up our center column, our actual hours of 4,400 hours at our standard rate of $20 per hour, we can see right away that this would have given us a favorable rate variance because our actual labor cost of $18 per hour was less than our standard labor rate of $20 per hour. Our efficiency variance, which is basically the same thing as a quantity variance, but we say efficiency and rate when we're dealing with labor versus price and quantity when we're talking direct materials. It is unfavorable because it took us longer, 4,400 hours, to produce our units than what it should have taken us, which would have been 4,000 hours. Calculating the center column, we've got $88,000. Our rate variance is the difference between the 88,000 and the 79, or more precisely, it's the $2 an hour difference in our labor rate multiplied by our 44,000 actual hours. Our efficiency variance is the difference between the 88,000 and the 80,000, or $8,000, or more precisely, it's the extra 400 hours that we spent at $20 per hour. Notice in this case we have a favorable variance and an unfavorable variance. The two net against each other, leaving us an $800 favorable direct labor spending variance. But more precisely, that's the difference between our actual expenditures and what we should have spent. Let's go ahead now and calculate our variable manufacturing overhead variances. Once again, we're comparing the difference between our actual expenditures of $53,680 and what we should have spent, the $48,000. That gave us a $5,680 unfavorable variance. And that's because we spent more than we should have. Let's go ahead and prepare and calculate our variances. Again, we were told we worked 44,000 actual hours. We don't have an actual variable overhead rate, but of course we can back into it by taking our total variable overhead cost of $53,680 and dividing it by our 4,400 actual hours. Our standard hours, again, 80,000 hours, which was our 80,000 units, times 0.2 hours per unit for 4,000 hours. Multiplying that by our predetermined overhead rate, or standard rate of $12 an hour, gave us our $48,000 is what we would have expected to spend for variable overhead. Let's go ahead and calculate our center column. We take our actual hours, 44,400, times our $12 standard rate. We can see our rate variance is in this case unfavorable because our $12.20 rate, actual rate, pretend actual rate, is greater than our predetermined overhead rate or standard rate of $12 per hour. Our efficiency variance is once again unfavorable because it took us 4,400 hours longer than the 4,000 it should have taken us. In terms of calculating the amounts, our rate variance is $880. That's the 20-cent difference in our overhead rate multiplied by 4,400 actual hours. Our efficiency variance is 4,800, which is the difference in hours of 400 multiplied by our $12 an hour standard rate. Our total manufacturing overhead variance then, again, it's two unfavorable rates combined gives us the $55,680, or it's really more precisely the difference between the 53 and the 48. And it's unfavorable because we spent more than we had expected. Let's go ahead and pick up and calculate our fixed manufacturing overhead variances. Again, one of the things we start with, of course, is our actual fixed manufacturing overhead cost. And then for the center column, this can either be our flexible budget amount or our static budget amount, because they are one and the same. So 200,000. The difference between the two, we spent 4,500 less than expected, so we have a favorable spending variance. Let's go ahead and start picking up our amounts. Recall, we worked 4,400 hours. We can back into that pretend or fictional actual overhead rate of 44.43. Let's go ahead now and look at our applied. Recall, our standard hours would have been 4,000 hours to produce 80,000 units. We apply manufacturing overhead again based on our direct labor hours. Again, this is assuming that we're using a standard cost system where we're applying overhead based on standard hours. Had we been using a normal or traditional costing system, we would have applied overhead on the basis of actual direct labor hours. We would have had a predetermined overhead rate or standard rate for fixed manufacturing overhead of $40 per hour. This would have been our original estimated cost of 200,000 divided by our estimated original labor hours of 5,000 labor hours to produce 100,000 units. So that would have been our predetermined fixed manufacturing overhead rate. Multiplying the two together, we get 160,000, and that gives rise to our volume variance of 40,000. Again, that's the difference between our budget amount of 200,000 and how much we've applied, which is 160,000. One of the things you should notice that if we had originally met our production goal of 100,000 units, if we had met our original production goal, we would have had a flexible budget amount, or we would have applied 5,000 hours right here, and we would have applied $200,000 in overhead, and we would have nothing for our volume variance. That's because we would have spread our fixed manufacturing overhead out over more units. But we only produced 4,000 or 80,000 units, so we only applied 4,000 hours worth of overhead, and we had a volume variance of $40,000. This volume variance is unfavorable because we produced less than we would have expected. Our total fixed manufacturing overhead variance then is a $4,500 favorable spending variance, a $40,000 unfavorable volume variance, for a total variance of $35,500. And this is unfavorable because we have spent more than we should have spent producing 80,000 units. So again, an unfavorable fixed overhead variance because we have spent more than we should have spent to produce 80,000 units. Our 35,500, notice that's really the difference that we would have in under or over applied overhead. Think about our T account for overhead. 195,000 in actual, we've applied 160. The difference between actual and applied is our, in this case, under applied manufacturing overhead. And again, it's unfavorable because we've spent more than we should have to produce 4,000 units. And again, if we had produced 100,000 units, exactly what we would have anticipated, if we had been on our original budget, we would have applied 5,000 hours or 200,000. Our volume variance would be 0, and we would have a $4,500 favorable manufacturing overhead variance because we spent less than we would have expected to produce or spend at 100,000 units. But again, we only produced 4,000 units, so under our standard system, we applied 160,000 in overhead. We had a $40,000 volume variance, a 4,500 favorable spending for a net total volume fixed manufacturing overhead variance of 35,500, and it is unfavorable.